Thank you, Dr. Hushman, and good luck this afternoon with your speech, and we're grateful for the time to be with us today. Okay, so our first panel discussion, I'm going to invite up our topic to kick off is what is ESG? So I'll welcome to the stage Jordan Howell, Associate Professor of Sustainable Business, Jeremy Schwartz, the Global Chief Investment Officer from WisdomTree, and our moderator today will be Jordan Moore, Assistant Professor of Finance.
Hi, good morning, everyone. My name is Jordan Moore. I'm a faculty member here in the finance department at the Rohrer College of Business, and I appreciate the opportunity to moderate this session. I think this session will provide a great overview on ESG for the rest of the conference. The way I see ESG is as an alternative viewpoint to the traditional viewpoint both in academia and in industry, thinking about individual firms and businesses as being profit maximizers. That's really what they're there to do. In reality, we're all human beings, and we care about a lot of things, and the businesses we work for should care about some of these things too, including environmental responsibility, social justice, corporate governance, and this alternative ESG viewpoint has had a massive growth in the last 10 to 20 years. ESG is an important emphasis not only at the Rohrer College of Business, but Rowan University as a whole. So I'd like to thank you all for joining us today. We're going to have two speakers. One is a very accomplished finance industry professional, and our other speaker is an academic working on cutting-edge research in the area of sustainability. So our plan for today is that each speaker has some prepared remarks that should take about 15 minutes, and that should leave hopefully 10 to 15 minutes at the end of the session for open discussion, and I'm sure a lot of you will have many questions for our two experts here. So I'd like to start by introducing our first speaker. Mr. Jeremy Schwartz is the Global Chief Investment Officer of WisdomTree, which is a provider of exchange-traded funds and a fund manager for investors with unique objectives, including objectives related to some of the ESG goals. Jeremy leads an investment team to construct equity indices, quantitative strategies, and model portfolios. In addition to his very impressive work in industry, Jeremy is very active and visible in the ESG investment community. He is the host of the Wharton radio program Behind the Markets. He is the co-author of an excellent book in its 6th edition, Stocks for the Long Run, and he is an active member of the Philadelphia Chartered Financial Analyst Society. So please join me in welcoming our first speaker today, Mr. Jeremy Schwartz.
Have the slide order reversed.
That would be neat. Those are mine. Yeah.
I'm sorry.
Can we reverse the slides?
Do you mind just clicking through?
Just okay.
Sorry about that.
All right. Perfect. Well, thanks, Jordan, for the introduction, and always good to be here with the GIC and the group here. As Jordan just said, so the 6th edition of Stocks for the Long Run just came out, so it's about 2 weeks old, and I wanted to start with we actually have a new chapter on ESG in the book, so I put a few slides just on the highlights from that, then we'll get into the industry, the trends, what we see, and give some ideas on where I think the ESG investing trend is going. The opening of the chapter on ESG in the 6th edition of Stocks for the Long Run, we quote Milton Friedman. So in 1970, Friedman had this quote in the New York Times, and it became the mantra for the idea greed is good. But Friedman's talked about the goals of a CEO when all the people talk about trends towards social responsibility, Friedman talks about he has a direct responsibility to his employers, as the board, and the general idea is to make as much money as possible while conforming to the basic rules of society. So 50 years later, there's this big backlash against Friedman's quotes, and CEO of Salesforce, Mark Benioff, claimed he brainwashed the generation of CEOs that greed is good. And the question that we try to address in the chapter is, well, instead of Friedman saying the goal is to maximize corporate profits, but he said the goal is to maximize shareholder return, how would that have changed? You could say, like, what drives stocks, values? It's sort of certainly an element of corporate profits, but also multiples, and what you're willing to pay for those corporate profits. And so this question is, can the drives for ESG actually help increase profits, but also help improve valuations? If people are willing to pay more for the business, that could be very good because you're following those ESG principles. Now, as investors, you think about if things are now priced at higher multiples over time because people are willing to pay more for ESG stocks, that could mean they're set up for poor forward-looking returns, right? So the idea of can ESG be rewarding as an investment strategy? Well, people are paying too much for it, then you have worse forward-looking returns. You get that in bond land immediately, right? If a bond has a lower coupon, you're going to get a lower return. And so if you're paying more for these good ESG stocks, it could be worse for shareholders. But the idea of if the ESG principles lead you to better corporate profits, obviously that is a different story. So how can ESG lead to better profits? Well, there's all sorts of examples, and if people are willing to pay more for certain goods like the electric vehicles and Tesla, if people are willing to pay more for that, there's good reason to say those companies are going to do very well, lead to better corporate profits. And if you have better principles of the G in ESG, governance, has always been assumed to be one of those things that everybody's looking for. Good corporate governance, good stewardship of the company. That what makes it a good investment. But I think that idea of valuations is one of the things that we talk a lot about in the book. Now, in terms of what are these ESG principles and how people apply them, so the E stands for environment, and people are focused on carbon emissions, pollution, all things about the environment. That's certainly one of the thematics. We're going to talk a lot about thematic investments as one of the applications for ESG. I think that's where we see a lot of energy going into the product development side. The S for social considerations, customer satisfaction, there's gender and diversity questions. Are companies appropriately diversified in their board level, at their management level? How are they involved in the community? How do they treat their employees? G on for governance, that comes back to the board composition, executive compensation. Are you doing the right principles for governance? That's been the most straightforward, as I mentioned. Now, how people apply these in practice, it started off with a lot of exclusionary screens. We're going to exclude all the polluters, all the energy companies, high carbon emission type companies. That's where it started. Then people started going towards positive screening, not just excluding companies, but saying they screen well on specific metrics. There's norm-based screening. You have this UN Global Compact, which is one of the principles that people have been doing. Where we see a lot of energy is called ESG integration. I'm going to show some data on the types of strategies of what people are going. This is one of the biggest growth areas for where we really see it going is ESG integration. Thematics, sustainable thematics, I think is also where I think long run you're going to get more interest in. We'll talk about that. There's impact investing, and then corporate engagement is sort of this other category. In terms of I'm going to skip through a few of these slides. In terms of the flow, so this is what I was saying, the largest category today is ESG integration strategies. In 2016, we showed about you've got about 140% growth, and it's now the largest category. I think this is 25 billion versus 10 billion in terms of the growth in the last few years. the exclusionary screening, it was 15 billion and still 15 billion. So this is where I talked about this. If you just were excluding companies on ESG criteria, that's not growing as much over the last 5 years. It's really the integration strategies. In terms of the fastest percentage growth, though, for types of strategies doing ESG investing, the sustainability theme up 600%. So only a few hundred million to 2 billion. That's where we saw a big growth in assets. So in terms of the types of strategies, where you're seeing growth, ESG integration, what that would mean is not just looking at fundamentals, so your earnings and your sales growth, but actually are you integrating ESG factors into your approach? That's what we've done at WisdomTree, some ESG-based ETFs. We have a family, we call it a multi-factor process where we're looking at value, quality, momentum, as well as some ESG criteria, some composite ESG criteria. There's groups from MSCI. We're using a group called Howell that tries to take all the different ESG inputs, normalize them, and then get one final ESG score. We use that as one of the factors in this multi-factor approach for our ESG integrated strategies. Now, we are a global business at WisdomTree, so we have a big presence in the US, but also a European presence. And the mentality in Europe is very different than the US. In Europe, if you don't have ESG, even the basic screening, and a lot of it is the exclusionary screening that I talked about, is how it started, but not really where it's going. Every basic ETF we have in Europe now has some type of ESG principle. And the regulators look at it very differently over there. So there's what's called Article 6, Article 8, and Article 9 strategies. Article 9 is like the green standard, like the ultimate green standard of you want that it's the highest level of ESG standards in Europe. There's this Article 8, which is you apply it, but it's not the stated objective. But Article 9 is you really are the most forward-thinking. We've got a few Article 9 strategies in Europe, and it's really focused on things like, I'm going to give an example here of recycling and decarbonization as the types of companies that are trying to reduce carbon from the atmosphere, not just, again, excluding it, not just avoiding the energy companies, but how do you actually make a positive impact? In the US, if you were to try to add ESG criteria to your prospectus, you get a lot of backlash from the SEC. It's very scrutinized. There's fears of greenwashing. But in Europe, if you don't have it, it's a real problem. So it's very interesting how I think Europe is leading the ESG efforts, where the US is still trying to figure out what it is. So I think that's just another interesting thing of just how much more present it is in Europe than it is in the US. And the question is, will it come to the US in greater fashion like that? Obviously, there's a lot of policies going around that are driving this sort of legislation towards the decarbonization initiatives. I think the things that we're seeing, there's 17 Sustainable Development Goals from the UN, and we're seeing applications of those 17 Sustainable Development Goals driving products, including we're looking at, can we launch products tied to that in some thematic fashion? And so each of those 17 Sustainable Development Goals could have different ETF ideas tied to them. That's something we're working on with our European team. Where you see this idea of decarbonization, and this is, one of my questions is, with all that's going around in geopolitics today and the energy issues that Europe has, a lot of people are saying ESG was some of the culprit, that you're not getting investments in energy because of this trend towards ESG. And you look at the long-term trends for energy production. Today, 84% is coming from fossil fuels. Is it not happening fast enough? The move from nuclear is one of those big questions. Is Europe went away, they started relying on Russian natural gas. How are they, they're not going back towards nuclear? That's going to be one of the big questions to me. Will they return to some of that? But the goals of driving away from fossil fuels to these alternative sources is, I think, going to be one of the big ESG questions for people. And I wonder, well, how will Europe, given that so much of the ESG is coming from Europe, will what's going on with Russia change anything over time? In terms of how I mentioned thematic applications is one of the things that we're thinking very heavily about. I think there's applications in the commodity space. So this is just an example of, we launched a commodity basket tied to the energy transition metals, so what's needed for EV production, copper, aluminum, nickel, cobalt, lithium, is all part of the EV production cycle. And so one idea of a thematic basket was just creating the commodities that are going to be in demand. You could say there's going to be not enough copper to support all these things. And so we were creating these baskets in the commodity space to go after the EV transition. But Jordan does a lot of research on garbage recycling, so I gave a few slides on how we've thought through the recycling story. There's this talk about a circular economy, and there's the old linear model where you have these goods, you make it, then you dispose of them, versus the recycling circular economy where you take it, you make it, then you just recycle it back into sort of further going back into that whole cycle. In terms of where those are, renewable natural gas is one of these ideas. Given so much energy is the crux of the issues. One of the big trends in our recycling strategies is to take, it's very interesting of where you take the biodegradable waste, they apply these different anaerobic digesters. It takes from sort of animal waste and brings it back into natural gas. And so there's a whole bunch of different companies. It's a small thematic, but it's one that's a great example of where you're not just doing these exclusionary companies, but positive companies that can actually have this impact on the environment. And that's, I think, one of the things that we're trying to create strategies around. I'm going to let Jordan go on more on the recycling area. I'm going to transition it over to him to John Moore.
Thank you, Jeremy. Next, I'd like to introduce our expert academic speaker, Dr. Jordan Howell. Jordan is an associate professor of sustainable business here at the Rohrer College of Business. He also serves as director for the Rowan Center for Responsible Leadership. Jordan's research focuses on developing financial innovations and market-based solutions to address environmental issues. Jordan is one of the most prolific researchers at the Rohrer College of Business in terms of raising external funding. His research has been supported by the National Science Foundation, the United States Environmental Protection Agency, the New Jersey Department of Environmental Protection, and many others. Jordan, in addition to his incredible research output, truly as an educator has a tremendous passion for working with students to arm them with tools for businesses to address important environmental challenges. So please join me in welcoming our next speaker, Dr. Jordan P. Howell.
Hi, everyone. Thanks to Dr. Moore for the generous introduction. Also 16 handicap involved. He didn't mention that. That's not very good, but anyway.
Oh, yeah.
Jordan's much better than me. Yeah, sure. So, in any event, as mentioned, my name is Jordan Howell. Not to confuse everyone, two Jordans at the same time. I'm a professor of sustainable business here at Rowan. Hey, Jeremy, I think you have the clicker. If I'm back. Yeah, that's okay. I have to go backwards, right? We'll get there. Okay. And so I also direct the Center for Responsible Leadership, which has a mission of examining the roles of business in society with regard to sustainability, social impact, and business ethics. So what I'm saying is, if there's a person on this campus who believes in the power of business to bring about positive changes to our planet more than me, I've yet to meet them. I really believe in the transformative power, positive power of all of these companies and markets and tools that we have in the realm of business. So part of my job is to understand what works and to tell students about it. Part of the job is also to be productively critical of concepts and strategies that aren't really getting the job done, particularly with regard to environmental sustainability. And so here we are. Maybe you have a sense of where this is going to go. Talking about the new kid on the block, so to speak, ESG. I want so badly for this concept to be the engine powering our planet back to health. and I think it can. But there's a lot to the subject that has to be unpacked, and quite a lot of bravery among the investing community will be required to actually achieve the promise of ESG. So let me start with this. As you may know, there's arguably more capital available on the planet than at any point in human history in terms of financial capital and human capital. But one problem facing this flood of finance is determining where to direct investment. One objective, as ever, is simply to direct investment to the place promising the highest returns. A more recent objective is to direct investment, or at least some of it, to the places and projects that will, yes, return on the investment, but also catalyze positive environmental and social outcomes. And this new focus appears to be related to broader changes in investors' expectations, as Jeremy mentioned, but also a fluid regulatory environment. So of course, investing in the environment and social issues is not new. It was, by and large, however, the preserve of charity and philanthropy, which would provide financing for projects and causes with no real expectation of a monetary return. What's new lately is mobilizing capital to invest in environmental and social issues to achieve positive outcomes there, while also holding the expectation for a monetary return. So of course the thinking is that since most people and institutions are not in a position to give away money in a charitable sense, investment in the environment and society has been limited. If you attach a return to that investment, however, more folks should want to invest. So I ask all of you, what could possibly go wrong? Well, as you know, when it's perceived that a huge market opportunity is unfolding, new providers of a good or service will pile in. In this instance, the market opportunity is so-called sustainable or ESG investing, and the new providers are, in fact, the usual suspects, Wall Street firms. The growth in ESG products has been astonishing. As a recent report from New York Times Dealbook showed, as of 2022, there are currently 588 sustainable funds and ETFs in the United States, an increase from 203 in 2017. The assets in them have grown to $296 billion from $70 billion. Anyone who could launch a new product or reposition an existing product as an ESG or impact or sustainability product, all in quotes, has basically done so. Along the way, these products have frequently featured new, higher fee structures. The ESG boom has also been accompanied, in fact, facilitated by the very lucrative sale of ESG data and analysis of questionable environmental value. As Michael Bloomberg might tell you, the real money is not in the investment product itself, but rather the proprietary data that everyone on Wall Street has to use in order to craft an investment strategy. WisdomTree excluded, of course. We can't fault Wall Street for creating and selling products that investors have been clamoring for. Not only is it good business sense, but in this instance it affords Wall Street firms the rare opportunity to position themselves as making a positive impact on pressing social and environmental issues. But I have to ask the question, what good is ESG investing actually doing? Unfortunately, the answer is, with respect to positive environmental and social impact, not very much. George Serafim, one of the leading experts on ESG as a management concept, and at times one of its loudest proponents, made this point earlier in the year, again to the New York Times. Many ESG funds are doing very little of anything, in fact, as they are quasi-index funds with minor tilts and with no engagement or stewardship capability. Tariq Fancy, who many of you may have heard of from his tour around the business media circuit last year, had similar comments. Mr. Fancy is the former Chief Investment Officer for Sustainable Investing at BlackRock, which is a big deal in this instance because BlackRock is itself the largest asset manager on the planet, and BlackRock's CEO is perhaps the loudest, most public voice calling for additional ESG investment in investment vehicles. You may recall that Tariq Fancy left in a huge blow-up from BlackRock, asserting along the way that the entirety of ESG investing, at least as practiced by mainstream Wall Street firms, is a house of cards. He makes a point in an essay from 2021 that sustainable investing is a confusing area of finance that often means different things to different people. Most of the time it means building investment portfolios that exclude objectionable categories, such as divesting of fossil fuel producers in an apparent attempt to fight climate change. Here's the important part. Unfortunately, there's a difference between excusing yourself from something you do not wish to partake in and actively fighting against something you think needs to stop. So we can keep going and going and going with voices critical of ESG. The situation is to the point that after allegations of ESG-related fraud at Deutsche Bank, Goldman Sachs, and BNY Mellon most recently, among others, the SEC is investigating products and also looking to craft clear rules and guidelines for issuing and advertising ESG-related investments. It's pretty clear to those of us paying attention to this space that ESG, as practiced by mainstream Wall Street firms and providers of investment products, does not achieve the environmental and social outcomes that are desired. So the products on offer are not specific enough in their goals to achieve the promise of ESG investing. Fund managers are excellent finance professionals. They're not necessarily environment, sustainability, and social impact people. Therefore, these types of vehicles and approaches will always struggle to achieve the desired real-world impacts. But I promise, I'm not ending the conference early with my comments here. So there's a ton of value to the concept of ESG. There's also tons of evidence supporting the assertion that companies with well-managed and thoughtful sustainability and social impact investments really do perform better financially as well in the long term. So what that means is there should absolutely be scope for directing flows of capital into sustainability-oriented firms and projects. We just have to go about it differently than what's been ramped up in recent years. So I want to spend the rest of my time with you this morning highlighting a few areas in which the ESG concept can be deployed in a way that is more likely to produce the intended environmental and social results. So they focus on three areas: conservation finance, environmentally linked derivatives, and venture capital and private equity. So the planet is neck deep in twin crises: climate change and the loss of biodiversity. Conservation finance is one area of investment activity that addresses both simultaneously by creating mechanisms for supporting land preservation and habitat preservation schemes. One of the more interesting firms in this space, which I'm proud to say has hosted several Rowan interns in the past few years, is Conservation Capital. CC has as their mission harnessing progressive business and finance tools to build resilient natural landscapes. In practice, that has meant working on the cutting edge of both creating new financial instruments, like the biodiversity bond, which recently launched, and ramping up new types of markets for debt financing and equity tied to businesses working directly to achieve conservation outcomes. With conservation finance, there's a direct one-to-one relationship between investment and environmental outcome. One problem these firms and initiatives face, though, is in identifying the conservation partners of high enough quality to actually invest in. So thinking about growing the ecosystem for conservation finance, pun intended, means also growing the ecosystem for entrepreneurship in some of the most economically disadvantaged places on Earth, which in the long run is likely a win-win scenario. Another area in which the ESG concept is poised to make strong on-the-ground improvements to sustainability issues is the vast world of derivatives. You probably know derivatives as things like futures contracts, interest rate swaps, and everyone's favorite, the collateralized debt obligation. We can create derivative instruments for anything, including some of the pieces underlying direct action on environmental issues. For instance, along with some Rowan students, I completed a case study in New Jersey's own Pinelands Development Program. This program establishes a market for property owners in environmentally sensitive areas to sell their rights to develop their property in exchange for a cash payment, while retaining ownership of the land itself. Credits are bought and sold on an exchange that anyone can participate in. Even if you were engaged purely in speculation, your investment in this area would create positive environmental outcomes. One could very easily imagine some fund out there, don't steal my idea, having the strategy of making returns through trading these and similar types of credits generated in similar models. Indeed, so-called commodity aggregator trading firms perform a lucrative function in the market for things like solar energy credits and other types of renewable energy credits, bundling these things together and selling them on to large utilities. If you don't like the land and energy derivative markets, we can imagine them for commodities as well. For instance, along with our moderator, Dr. Moore, and our colleague, Daniel Volkenstein, we've been working on establishing a futures market for recyclable plastic, which will make these materials infinitely easier to work with for manufacturers, in turn getting more recyclables back into the economy and out of landfills and oceans. The last area I'd highlight this morning is the realm of venture capital and private equity. There's tremendous scope for VC and PE firms to make positive environmental and social impacts because of their managerial roles and ownership stakes in the firms they invest in. While we can hope that the largest firms in this area would have a quick and complete change of heart to invest only in sustainability-oriented projects, this is likely not going to be the case. Fortunately, there's an increasing number of sustainability-oriented venture capital and private equity firms and funds looking explicitly to support companies with different types of solutions to environmental and social problems. I highlight here just one of these, established a few years ago and now one of the largest in the space that's focused on the waste and recycling industry, called Closed Loop Partners. There's a long way to go, however, to get solutions like these that are actually true to the promise of ESG investing anywhere near the scale that the mainstream Wall Street products have achieved. First of all, there's not that many firms offering real ESG solutions. They are smaller, they're harder to access than major investment firms and brokerages. Even if many real ESG firms were more widely accessible, they would quickly find themselves in the situation not having enough quality projects to invest in. And beyond that, given the way accredited investor rules are written, it's possible that most funds and products would remain out of reach of smaller and retail investors anyway. But this commentary I offer just as a photograph of the status quo, not a prescription for how it has to be. Changes in all the areas that I just mentioned are possible and necessary. Second, I think there has to be greater leadership from sources of so-called patient capital, investment entities that are not looking first and foremost at quarterly or annual or even decade-long returns. So things like university endowments, pension funds, family offices, trusts that have long-term goals, maybe indefinite-term goals at the top of their investment priority. These entities can take time to vet and invest in longer-term, real ESG projects, products, and firms that might make a return in a decade or longer if they ever do. I'll even use my platform this morning to call on Rowan University to demonstrate the same type of leadership we show in other areas by establishing a patient capital investment fund. I'll volunteer to direct it for you, so I don't make more work for Sue. So to conclude, ESG is an idea whose time has come, should have come a long time ago, to match huge amounts of capital with projects and companies that are positioned to move us towards a more sustainable future. But we should be very skeptical about the potential for mainstream ESG to achieve these results. We must commit to doing better by finding and investing in projects which will generate not only financial return, but the environmental and social outcomes that we so desperately need. And this is certainly a lot harder than it sounds. So I'll leave it there. Thank you. Feedback welcome.
Thanks again to Jeremy Schwartz and Jordan P. Howell for their incredible presentations. And thank you for sticking with the prescribed time limit. That leaves approximately, I believe, 10 to 12 minutes for audience questions and general discussion. So would anyone like to ask any questions to either or both of the speakers? Yes, sir.
I'll recommend.
Yeah, sure. Thank you all very much. Excellent presentation. Learned a lot from it. My question is this. What impact, if any, do you think the recent activity by the Attorney General of Texas and several other Attorney Generals around the United States to ask BlackRock and others about their underperformance in investment of state pension funds will have on the ESG marketplace?
I don't know if I have a specific thing. I mean, it's one of those questions on, and there's, and WisdomTree included. So do you think these things will have higher returns? Like, will lead to higher returns? And so when it started off, like the very first set of ESG funds were basically just excluding energy funds, you know, at the very basics. And or you look at the major factor tilts that they had, is they were, a lot of them were just excluding energy. And that worked for like the last decade until 2 years ago. And now, if you did include energy, now energy itself shrunk in the S&P 500 from a very healthy portion down to below 3%. But it's obviously getting more than just that. And I gave some initial comments to say, will ESG factors be higher returning or lower returning? And so the transition to better multiples is a time ESG should outperform. But once you're at the higher multiple, it's going to be a struggle going forward. One of the things we also talk about in the book that I really want to mention today is there's a lot of people talk about ESG improver strategies. This comes to the data and the selling of data, but should you focus on just high ESG scores, which excludes a lot of the underperformers, or somebody who's improving on that ESG factor? And the Rockefeller Group has actually done some research on this, and it's one of the charts we show in the book that the ESG improvers were outperformers versus the ESG detract, so people deteriorating scores. I don't know if I have a particular comment on that particular lens, but I think where we're seeing the regulators go is, are you doing what you're saying you're doing? We've obviously had some experience with the regulators on this question, and they're saying, if you claim you're an ESG strategy, are you really doing it? And I think that's where some of the firms are getting in trouble, is you need to actually display what you're doing and that you're following the principles that you set out. So we'll see how that evolves.
Yeah. So the first thing I would say is that it seems like yet another depressing illustration of how everything's politicized. You can't spill a glass of water without pissing someone off in the U.S. at this point, which is a disappointment. Sustainability is one of these things which is unnecessarily politicized, and I think there's some political theater going on in these states that kind of demonize any investment strategy or another. Having said that, you heard my talk. I don't think that ESG investing is necessarily making the sustainability impacts that it claimed in the first place. So I think the distinction is important. Is your concern that now there's a negative impact on sustainability outcomes because the Attorney General of Texas and Louisiana and others has said, hey, BlackRock, we don't like this? No, but there wasn't going to be a positive sustainability impact anyway. There's probably a real sustainability, or a real impact on BlackRock's business for selling these products or promoting them that might be concerning. So when I read about this sort of stuff or hear about it, I remind myself that it's all the secondary market anyway. This is not investing to bring new products or companies to market when you're at the scale of something like BlackRock. It's not these early stage firms that promise new solutions. It's not even IPO type situations most of the time. These are established companies that anyone could choose to invest in or not, and probably wouldn't make much of a difference with regard to corporate strategy at all. BlackRock has shown that no matter how many voting shares it owns, it probably will not vote in favor of sustainability shareholder resolutions anyway, despite what the CEO says. So it feels mostly like political theater to me.
Thank you.
I can stand up. Just talk about next year, 2023, with the R word, recession and inflation, how it's going to play with all this.
So the question on recession, inflation, I do think to me the most interesting question in all of this is energy prices and how it factors into all of that, and is how much of there's been all sorts of talk about the lack of, for energy-oriented firms, now even with high oil prices, are they investing enough for new production, and how much of that is the drive towards ESG and sort of poor returns to energy before, and how much is just oil prices were low and firms weren't investing around it. That to me is one of that ultimate question of where is the ESG trend going. Because of that, now you could say the lack of investment is going to be very bullish for energy prices, and I actually subscribe to some of that view. I think energy also has a very interesting role in portfolios, given its driving inflation. It's been one of the things that's hurting bonds, hurting stocks, and so I think it has a unique role. But the ESG trend generally, which is very anti-energy, or at least anti-carbon-based energy, is is one of those big challenges. For ESG investors, I think that's the ultimate question.
I feel like the answer to that depends on your time horizon. If you're a source of patient capital, then next year's recession is a bump in the road. If you're looking at a quarterly return, then I think you're very closely paying attention to all the things that Jeremy just outlined with regard to fossil fuel energy prices and interest rates and all that sort of stuff. The thing about sustainability is that it could probably care less if there's a recession or not. At some point, you can't eat money anymore. So you'd imagine that a lot of these firms that are kind of orienting towards more resilience in, agriculture, energy, supply chain, pick an area, they'll probably be better in the long run. So if your time horizon is that you can wait 20 years, or you can at least not have to sell that long, you probably end up further ahead by investing in these companies that are making strong sustainability investments now, or at least planning to, even if they do have to pare back because of a recession.
All right, Jeremy, Jordan, thank you for your presentation. Question. Publicly traded companies nowadays are, they're touting what they're doing from an ESG perspective across all industries. In the ETF construction process, or Jordan, in your work, how do you differentiate between a company that is really having a positive ESG impact versus those that are just giving lip service in your portfolio construction?
Well, as Jordan said, and we're a quantitative-based firm. We don't have thousands of analysts. Like we have, and I oversee our investment team, and it's very rules-based. You're using data and inputs, and it goes as you're going to be scored as good as the data. And so, we do need good, strong data providers. We did try to use, I mentioned we're using Howell, who's one of these aggregators of data. So they're trying to normalize between 10 different data inputs to try to get one ultimate ESG score. We also use Sustainalytics, who is one of the Morningstar-driven companies, for some of the inputs as well. So there's a combination of the screening and then as well as the scoring. And we do have some exclusionary stuff in our ESG forward funds, and then we have, but I talked about the ESG integrated. So we use that Owl Shares composite score as the fifth factor in our multi-factor process. So we are scoring for the top, call it 300 companies on value, quality, momentum, low risk, and this ESG integrated score. And then we use that in the weighting as well. We do try, you're going to be as good as the data, so you need robust data, but you can talk to 3 different firms and have 3 different opinions, which is why I think the standardization of scores is important.
I think that the data science question is one of the most serious issues facing sustainability and investing, because as Jeremy just said, you have 3 different firms and you'll have maybe even more than 3 opinions on whether or not something should be included in an ESG fund or not. So I think that it's great that there's lots of variety, because it allows you to actually match kind of an investor perspective on what does sustainability mean with what they're investing in. In illustration, for a long time, arms companies were prohibited from a lot of ESG sorts of funds. Then Russia invaded Ukraine, and everyone decided, well, maybe actually we need arms companies in certain instances because you're defending people who are defending themselves from an invasion. And so you could make kind of a credible ESG case for like Lockheed Martin all of a sudden, right? Just to choose one company, which was maybe weird for some ESG people to be. At the same time, I noticed when you try to reduce some of the sustainability data down to a single score, you try to get it to the level of an index, right? Where there's one score for a company that represents the entirety of their actions. You exclude too much of the detail that would actually make it relevant for an investing purpose. The Economist a few months ago had a headline on their cover that said the only ESG score that matters is carbon emissions. Well, maybe, but maybe not. I mean, it depends on where you are, what is your product, what are you trying to accomplish with your company. Carbon emissions are certainly relevant. It can't be the only thing that you're judging sustainability on. So I think, I said before that a lot of finance industry people are excellent fund managers and excellent putting together things like ETF, but they're not necessarily experts in environment or social impact. What would happen if some of these firms decided to hire a lot of people to look at the fine-grained sustainability impacts of the companies before they make a decision about whether or not to include something in a particular ESG fund. You might end up with a really different portfolio, right, that bucks some of the trends that you see in quantitative reporting and things like that. It'd be an interesting experiment. I'd imagine there's probably some boutique firms out there that are trying to do exactly that.
Thanks for the presentation. My firm serves many of the investors that you mentioned, family offices, insurance companies, endowments, and foundations. We are held to a legal standard, a fiduciary standard, a duty of loyalty, a duty of care, and ensuring that we're doing the best thing for the client financially. We get the question from time to time, how do you square that circle? How do you deal with fiduciary responsibility as an asset allocator? And is there evidence in the research or in the data that suggests that ESG investing is actually in the best interest from a financial standpoint? How would you advise us to advise our clients? I'd like to hear from both of you, please.
Yeah. Okay, well, I'll give you an academic answer that you won't like. But one thing is that, Jordan's answer is going to be different than the Chancery Court of Delaware's answer on what is a fiduciary duty. I would say if you're advising a family office, I would imagine that many times their goals are to preserve capital for future generations, at least in part. Well, what's a better long-term investment than, I don't know, carbon neutrality or something, making sure your grandkids can enjoy the outdoors or something like that. It's not maybe as scored as highly as a financial return, but it's certainly in your client's best interest. It may not always be in the best interest of short-term return. One comparative case that I think is really interesting, you may all know Harvard University as one of the largest university endowments on the planet. They own all sorts of weird stuff in the name of environmental and social impact. They own a forest. They own a number of forests. They own vineyards, for God's sake. They do this because they're trying to demonstrate that you can kind of successfully run things from a sustainability perspective that also will make a financial return. Now, in that instance, there's $30 billion endowment or something like that. If they lose a little bit of money in 10 years on some particular forestry project, no one even notices. It's a rounding error, right? But when you're at a certain sum, I think the difference is that you can afford to wait longer. They've openly said that some of their investments, they don't expect any return for 100 years. Well, that's a very small portion of the investing public that's able to make that. So it almost seems like a sell on values. Do you value actually, having a return in the immediate future within your lifetime? Or are you comfortable knowing that you're investing money in something that maybe your children's children will benefit from more than you? Or people you don't know might benefit more than you? And as I said, that may not always square with the legal definition of fiduciary duty. But I would imagine if your clients say, no, I really want the second thing, the values-based thing, you have some sort of legal protection there, right?
Bill, I would just keep emphasizing that the client, a lot of what we're doing in Europe is because the clients are absolutely demanding it. We can't launch a product in Europe without including those screens. At least our team's perception of their clients is that it must be included. And they want more of the Article 9 funds that are very forward-thinking, not just the basic screening where it doesn't get the Article 9 classification. So I do think that it depends on each client's perspective of what's going into it. And there's a bunch of research on the ESG improvers that it can actually lead to better returns. And the question that I came back to the start with the Siegel worldview is if these things are selling at higher multiples, they're going to have a worse forward-looking return. So you got to see where you are in the cycle. Are they now pricing it in? They already get that premium pricing. Think Tesla as an example of that. But I do think each client's going to have their stated goals of what they're looking for. And coming back to the politicized of Texas versus California, you could say, as two different mentalities. But I think the clients will help you dictate the answer there.
Our hosts have informed us that we are out of time for this session. Thank you to the audience for all the great questions, and I hope you'll join me in one final round of applause.